Hello and welcome to this interesting webinar on ETFs powered by Nippon India Mutual Fund. So friends, there has been significant rise of interest among investors in ETFs and index funds. In fact, the industry has witnessed a steep growth of 40% in passive AUM in the last 1 year. And majority of this inflow has come through ETFs. So friends, most of us might know that ETFs are cost-effective way to invest in capital markets. But what goes behind construction of ETFs? How does ETFs actually work? And what is the taxation of ETFs? So to help us understand the nitty-gritty of ETFs, today we have with us Hemen Bhatia, who is head of ETF business at Nippon India Mutual Fund. Hemen has played a key role in making ETFs popular among Indian investors. He has over 15 years of experience in financial services industry. So I can say that we will going to benefit from his wisdom today. Welcome, Hemen.
Yeah, hi, Nishan, and thanks for inviting me for this session.
Great. So Hemen, I would start with a basic question that what are ETFs actually and how does it actually work?
See, ETFs are actually, in simple terms, if I can explain, ETFs are a mutual fund, which is a mutual fund scheme which is listed on the stock exchange. Yeah, given that it is listed on the stock exchange, it has the characteristics, many characteristics similar to a stock. For example, you can buy and sell ETFs real time during market hours, similar to how you buy and sell any other stock, and you can put trading stop losses. You can have limit orders similar to how you put in stock. So uh, certain characteristics are similar to stocks. At the same time, it's an open-ended fund, right? It operates like open-ended fund, like any other mutual fund. So investor can buy and sell in any time during the life of the fund, enter any time and exit any time. So the characteristics of mutual fund are also there in a ETF. Apart from that, ETFs are very transparent. While I say transparent, ETF mimic a particular index, right? So the index constituents are decided based on a pre-decided methodology. So ETFs are also very transparent. So we say ETFs are best of both worlds. They trade like a stock and they operate like a mutual fund.
Okay. But Hemen, how is ETFs constructed? I mean, how it is, how unit has been created?
So as I said to you, for example, say suppose a Nifty 50 ETF. So a Nifty 50 ETF tracks the its underlying index, which is your Nifty 50 index,
Hmm.
right? So all the constituents which are part of the Nifty 50 index will be part of the Nifty 50 ETF. And
Hmm.
while I say constituents, the stocks and the weightages of the portfolio of the ETF will mimic the weightages of the constituents which are part of the index. So that is one example for a broad market index like say Nifty 50, which is some sector fund, say a banking ETF. Then that banking ETF will replicate the stocks and the weightages of the underlying banking index.
Hmm.
So the ETF is designed to mimic the underlying index, and the stocks will be exactly in the same weightage, very close to the same weightage of the underlying constituent of the
Oh,
index.
okay. So Hemen, if I have an option to buy whether I can buy, I mean, XYZ company stock or and XYZ company ETFs. So why should I buy XYZ company's ETF instead of XYZ stock?
See, ETF is ultimately a basket of stocks, right? Which are part of the index. So suppose if you buy X stock or a Y stock, now what happens is there will always be a question of outperformance or underperformance while you buy a particular stock. That stock may or may not outperform in the future. With ETF, what you do is you are buying an index, right?
Hmm.
So whatever is the market return will be the returns of the ETF, and a lot of those non-systemic risk like stock picking risk gets reduced while you buy a ETF, and what you are left with is the market is just the market risk,
Hmm.
which may be risk specific to that particular asset class and common to all. So you are not subject to outperformance or underperformance in future, but the investor will get the returns in line with the markets, depending on which ETF the investor has entered, and that ETF tracking a particular index.
And I mean, just like India index restructure itself automatically, my ETF investment will also get restructured automatically because the restructuring happens in the index. Is it so?
Yeah, so what happens is, given that the portfolio will mimic the underlying index, whenever there are any rebalances, for example, there are some corporate actions which are there in the index, or there are some inclusions or exclusions as per the index methodology, the index provider intimates the ETF manager, and ETF will be rebalanced based on those changes which are going to happen in the index. At
Okay.
any point of time, the ETF will try and mimic the underlying index as closely as possible.
Okay. So, Hemen, how can an investor invest in ETFs?
See, there are two ways of investing in an ETF. One is, given that ETF is listed on the stock exchange, an investor can buy and sell the ETF just like buying and selling the stock,
Hmm.
right? So they can buy and sell the ETF through any stockbroker. Uh, uh, and there another way of buying and selling ETF is coming directly to the AMC. But while somebody comes directly to the AMC, they can buy and sell only in certain lot sizes.
Hmm.
Okay, that lot size will be predefined by a particular AMC in terms of number of units of a particular ETF. So investor can come directly with the AMC and buy and sell the units of the ETF as well. So two ways: one is on the stock exchange, another is directly with the AMC. But with AMC, it comes only in certain lot sizes.
Okay. And ticket size would be higher in AMCs compared to market?
Yeah. So, for example, certain say any Nifty 50 ETF, it will differ from fund house to fund house, but it will be few lakhs basically, 5 lakhs, 10 lakhs, 20 lakhs, or 25 lakhs, depending on the unit size of which a particular fund house has decided. Obviously, as compared to pricing of one unit on the stock exchange, which can be in 2 digits or 3 digits,
Hmm.
here investor will have to pay higher amount for buying in certain lot.
Also, you need to have a demat account, right?
Yes, so for buying ETF, investor has to compulsorily have a demat account, similar to buying any other stock, right? Stocks also, all the stocks, for buying a stock, you need a demat account. Similarly, given that ETFs are also listed, you will require a demat account to buy a ETF.
So, Hemen, what?
Demat as well as trading account. Demat as well as trading account, to be precise.
Okay. So, Hemen, what are the key benefits of ETFs?
Uh, See, as I said to you, ETFs are listed on the stock exchange.
Hmm.
They have got the characteristics of a stock. They have got the characteristics of an open-ended fund. And a lot of non-systemic risk. As I said, a lot of non-systemic risk get reduced while you invest in a broad market-based ETF. So a lot of this guesswork which happens while you buy a stock, or you buy a particular sector, or you invest in a particular active fund. Okay, a lot of those non-systemic risk get reduced while you purchase a ETF, and your returns are ultimately aligned with the market, right? You don't have to get into the guesswork of what will outperform in the future, and take a call accordingly. So you will get the market returns while you invest in the ETF.
Okay. But what are the key risks associated with ETFs?
Risk, if, as I said to you, see, ETF is mimicking a particular index.
Hmm.
Okay. So your stock picking risk, fund manager selection risk is actually not there in a ETF, because at any point of time you will be mimicking the index. What remains, so all these non-systemic risks are out. What remains is just the systemic risk. Whatever are the market risk is what will remain in an ETF. For example, if it is equity asset class, whatever is the volatility of the equities and a particular index is what will be the volatility of the ETF in which investor is investing. So only the systemic risk remain, whether it is equity as an asset class, whether it is fixed income as an asset class, or whether it is commodity within commodity, a specific commodity as an asset class. Yeah. So only the systemic risk will remain, non-systemic risk get reduced. But again, I'll suggest that any investor who is investing in a ETF, I'll request them to go through the offer document before investing.
Okay. But Hemen, what is the role of fund managers in ETFs according to you?
Uh, See, in a ETF, the role of a fund manager is to mimic the underlying index as closely as possible, and try and keep the tracking error as low as possible. There is no stock picking, there is no sector selection, which is happening unlike active funds. So at any point of time, fund manager has to mimic the underlying index and ensure that any rebalances which are due because of the corporate actions or because of the inclusions and exclusions in the underlying index, those are taken care of so that at any point of time the portfolio is very close to the index constituents.
Okay. And what are different types of ETFs, Hemen?
See, today, while we talk, there are a host of ETF which are there in the market now. So almost there are some 140 plus ETFs which are there in the Indian mutual fund industry, spread across asset classes. While I say asset classes, ETFs are spread across equities, equity ETFs are spread across fixed income, and they are spread across commodity as an asset class. Within equities also, there are a lot of ETFs which are available across. So within equities, you have domestic equities and you have international equities, right? So within domestic, you have broad market based ETFs, say like a Nifty 50 ETF or say a Sensex ETF, a mid cap 150 ETF, or say a Nifty Next 50 ETF. Yeah, you even have sectoral ETFs. So there are ETFs on banking index, auto index, IT index, even pharma index. Yeah, this is on the domestic equity side. Then there are thematic as well as smart beta indices. While I say thematic, somebody may want to invest in an infrastructure index. So there are ETFs on infrastructure ETF. Somebody may want consumption as a theme. So there are ETFs on consumption index. And then there are smart beta indices like say NV20, Value 20 index, or say Alpha Level index, etc. Yeah. So there are a lot of ETFs available on the domestic equity sides. On the international side also, there are ETF based on the Hang Seng index. There are ETF based on Nasdaq index. Various ETFs even on the international equity side. On the fixed income side, now there are variety of fixed income ETFs also available. There are ETF based on the money market instrument that is tracking the daily CVLO rate. There are ETF which are target duration based. So, for example, what I mean by target duration is somebody wants to take a call on the 10-year yield. They have a view, and so there are ETFs mimicking the 10-year yield curve. There are ETFs mimicking the 5-year yield curve. Yeah, and there are even ETFs which are target maturity based. Somebody wants to invest and buy and hold underlying securities till maturity. So there are target maturity ETFs as well, wherein you just buy it and forget it till maturity, and so there is visibility of returns in those ETFs. On the commodity side, there are ETFs on gold as well as silver ETFs, which are the two asset classes available if a portfolio manager has to construct a 100% commodity ETF based on that particular commodity. So variety of ETFs, and investors can actually construct their portfolio using this variety across asset classes.
Okay. So, Hemen, what factors should an investor keep in mind to select ETFs?
See, investor, generally the perception is that all ETFs are equal. For example, if it's a Nifty 50 ETF, most of the fund houses offering Nifty 50 ETFs are equal, right? But let me tell you, all ETFs are not created equal. The investor should always do a Victor test. What is a Victor test before investing? So V stands for volumes. So volumes are the volumes of that particular ETF on the stock exchange. So higher the volumes, better it is for the investor, so that the investor can buy and sell the ETFs close to the fair price, close to the real time now. Second is IC in Victor stands for impact cost. So impact cost is the cost which an investor pays for buying a ETF on the exchange for a desired quantum, right? So generally the impact cost will be higher or lower depending on the liquidity of a particular ETF on the stock exchange. So lower the impact cost, better it is for the investor. T in the Victor stands for tracking error. So lower the tracking error, better it is. As we discussed, acid test for a ETF fund manager is to keep the tracking error as low as possible. So lower the tracking error, better it is for the investor. And ER stands for expense ratio. Lower the expense ratio, better it is. But again, while taking the Victor test, investor should remember that none of these parameters should be looked into in isolation. All these parameters should be looked in totality without isolating any of the parameters. And that will help the investor decide which ETF to choose amongst the ETF which are benchmarked to a particular benchmark index.
Okay. So, Hemen, how can an investor make investment portfolio through ETF? So, can you suggest a few, must-have ETFs categories?
See, ETFs, I'll say ETFs, we say is a very versatile instrument. So ETFs are actually can be used for various strategies. Yeah. So there can be investors or advisors who can use ETF for doing their asset allocation. So as we discussed, there are multiple ETFs available across equity, fixed income, and commodity indices. So investor can very easily practice asset allocation using ETFs because of the operational ease with which they can get exposure to a particular asset class. Investors can even use ETFs as part of their core and satellite strategy. So while what do I mean by core and satellite? So core, we generally suggest that core should be your ETFs or say instruments which can capture your market beta. Market beta is nothing but your market return, right? So your majority should be in your core, and satellite can be anything from stocks to AIFs, PMSs, active mutual funds, anywhere where the investor or advisor feels that that particular instrument can generate alpha. So investor can divide their portfolio into core and satellite. The weightages can depend on the risk appetite of that particular investor. So for asset allocation, for core and satellite, yes, a lot of investors can even take tactical calls. So for example, on a particular sector through ETFs. So for example, if an investor feels that a banking sector, they have a good view on banking sector and banking sector is going to outperform in future, investor can just simply buy a banking ETF rather than buying individual banking stocks wherein they will have to guess which stock is going to outperform in future. Simply buy a banking ETF, and once the view fructifies, just redeem, sell the ETF and book your profits. Similarly, investors can buy auto ETF, pharma or IT ETFs, and in fact they can do shuffling between ETF based on the tactical calls on different sector at different point of time. And so this is one more use. A lot of investors can even use it for cash equitization. What is cash equitization? So a lot of investors who are into the market and who buy and sell stocks, suppose the investor has sold stocks and is sitting on handsome amount of cash, right? And they have not decided the next move in which stock to invest next. So investors generally do not want to miss market movements, so they can simply go ahead and invest in a Nifty 50 ETF, so that till the time they make the next move and decide to invest in the next stock, they will actually at least capture the market return. So various uses for asset allocation, for cash equitization, for core and satellite portfolio construction, and even for taking tactical calls. So ETF can be used across strategies.
Okay, Hemen, since we are talking about asset allocation, so do we have ETFs which tracks fixed income market or maybe commodities? Can you give some examples?
Yes, so there are ETFs tracking fixed income market. While I say fixed income market, there are ETFs tracking the 1 day TREPS return, basically overnight TREPS return. Okay, so somebody who just wants to somebody who sold a stock and wants has not decided on the next move, they can go ahead and invest in overnight TREPS. ETFs tracking the overnight TREPS. There are, as I said to you, there are ETFs which are tracking certain Nifty indices, say 8 by 13 Nifty index. What is 8 by 13 Nifty index? It is actually ETF index constructed with 5 GSEC securities
Hmm.
and with average maturity close to 10 years. So
Okay.
somebody having a view on the 10 year, they can track that particular, invest in that particular ETF. There are ETFs tracking the FIRE benchmark. Okay, FIRE GSEC benchmark. Yeah. Variety of ETFs on the fixed income side, apart from the target maturity ones which we discussed. In target maturity also there are ETFs across the course, few ETFs having a target maturity in 2024 and 2026, having a combination of securities. Somewhere it is AAA CPSE plus SDL. Few ETFs have 100% SDL securities also. So variety on the fixed income side. On the commodity side, there are ETFs investing 100% of the money in gold or silver.
So one last question, Hemen. What is the taxation structure of ETFs?
The ETFs have got taxation similar to any other open-ended mutual fund. For example, equity ETFs have got taxation of equity mutual funds,
Hmm.
wherein 12 months and more is considered as long term. So the long term taxation rate of equity mutual fund applies, and less than 12 months, if that is the holding period of the investor, then it is considered as short term. So the short term rates as applicable to equity mutual fund applies. And For anything other than non-equity mutual fund, the same rate applies as it is applicable for any other non-equity open-ended funds, wherein the long term is 36 months and more, and short term is considered as less than 36 months. So specifically for non-equity funds, long term is 20% with indexation, and short term is as per your tax slab, assuming you are a individual investor. And for equity mutual fund, long term is 10% without indexation, and short term is 15%. Yeah, and surcharge and cess applies wherever applicable. So for taxation, again, I'll suggest investors to consult their tax advisor to know the exact taxation of the ETF in which they are investing.
All right. So we have come to an end to this interesting session. Thank you so much, Hemen, for your, wonderful insights on ETFs.
Thanks, Nishan. Pleasure.
And finally, I thank each one of you for being such a wonderful audience. Have a great day, guys. Bye.